Okay, so that's it. Good morning, everyone. Um, I'm seeing we're still waiting for people to log in, but we're not going to leave the people that are logged in hanging around and waiting for the other stragglers to come in. My name is Vernon Trotsky. I'm the head of retail distribution for Sentio Capital Management, and this is our second and last Shari'ah Pulse session. And the idea with these sessions, as it's going forward, it's gonna grow. Believe me. Is the idea to just have a touch point monthly with our supporters base and people that are interested in our Shari'ah portfolios, so that they have an idea of what we're thinking in terms of the macroeconomics, what's happening in the world, then to position one or two of the shares we hold in terms of how they contribute to the performance, whether they are contributing to the performance, the reasons for that contribution, and then whether they're detracting and the reasons they are detracting and what our view is. And then we wrap it up with our look ahead in terms of macro variables for the month ahead, so that we can just position what to expect in the month ahead. So we are going into December, so the world is going to go a little bit quieter, we hope. But thank you for logging in and taking the time, whether we sit with one broker or whether we sit with 50, we value each and everyone's time and aim to give you value for the session and the time that you spend with us. So I'm going to hand the session over to Imtiaz Suliman, who's our head of our Shari'ah propositions and also a portfolio manager with us, holds the CFA designation, and he kindly agreed to do these sessions for us every month. So Imtiaz, with that said, it's over to you.
Thank you. Thank you, Vernon. Good morning. Assalamu alaikum to everyone on the call. Thank you for joining us today. As Vernon mentioned, we're going to give you a quick overview of our thinking with regards to the different themes in the markets, one or two stock contributors and detractors, what's working in the fund and how the fund is positioned, and what sort of key indicators we're monitoring for the next few months. So this will give you a nice idea into how we see the world, how we're positioning the portfolio, and how we're also looking for opportunities to take advantage of as the market presents. So we're going to keep it high level. I'll go into a bit of detail and we'll leave some time at the end for questions. Just in terms of some of the key themes and macro themes that we're monitoring from a global perspective, the one is definitely US inflation. It all hinges around inflation and Fed policy and what the Fed will do in terms of interest rates. So far, we've seen a massive increase in the Fed funds rate since 2021. As post the COVID period, we had interest rates being cut effectively to zero. And since then, you've had quite a steep and rapid rate hiking cycle. And by now, a lot of market participants, including us, would have thought that something would have been broken. But that hasn't been the case so far. And, there's a few reasons for that. We'll go into some of the details, but if you look at it from a company perspective, a lot of the debt that sits on companies' balance sheets were fixed at the lower interest rates, and the effects of this hiking cycle hasn't come through as yet. Now, this is something that will come through, and we'll speak about it a bit later in terms of US earnings. But we haven't seen the massive impact of that come through. And similarly, for households, they fixed a lot of their mortgage debt, which makes up the biggest chunk of households' debt at very low interest rates. And the thing is, in the US, mortgage rates are fixed for quite long term. So, you're looking at 5, 10, 20-year fixed mortgages, which has resulted in lower interest being paid. And as inflation has started to come down from its highs, in the US and around the world, we've seen real disposable income starting to open up, and that's providing some relief for the US consumer. And on the back of that, you had a lot of the pandemic savings, which has been drawn down, but that has been a buffer in terms of US consumer spending. And the US is a consumer-driven market, which, consumer spending makes up 70% of the US consumer. So from that perspective, it's been a very, call it robust, and there's been a strong underpin in terms of US consumer spending, but also corporates haven't been hurt by the rise in the interest rates that we've seen. Linked to the inflation and the macro outlook, is unemployment. Unemployment levels in the US were at record lows. They've ticked up slightly of late, but that hasn't been enough to tip the US market into a recession. And what you see usually, is when the unemployment rate in the US troughs and it moves from that bottom up by 0.5% or more, every time in the last 43 years, that has been followed by a recession. So whilst the unemployment rate has ticked up, it hasn't ticked up by 0.5% just yet. We're up by 0.3%. And, we haven't seen a US recession just yet. Now, whether we will see a soft landing or a recession in the US remains to be seen. But we think the odds and the probability of the US recession rather than a soft landing is the higher probability outcome. It doesn't mean that we're just positioning the portfolio for that scenario, but on a probability adjusted basis, you want to favor stocks that would do better in recession times rather than in the soft landing. And this is something that we'll calibrate and something that we'll be very nimble about. And also, humility is key. So if you look at it at the start of 2023, a lot of the strategists out there from the big brokerage houses, from sell-side analysts, buy-side research, the key view there was that the US would see a recession in 2023, given the massive amount of rate hikes that we saw in 2022 and going into 2023. And that didn't pan out. So, one has to keep a very open mind, and one needs to effectively navigate these markets because they surprise you quite often than not. From a global perspective, global growth has been quite strong, especially in the US. There's been certain areas that haven't been as strong. We'll touch a bit about China in the next few slides, but Europe also has been quite weak. It's all been about essentially the Magnificent Seven in the US, the theme around artificial intelligence and technology. So if one strips out the performance of the Magnificent Seven and a few other shares, like 3 other shares, effectively the S&P market is down for the year rather than being up 16%. And it just shows how strong a driver these large mega technology shares have been for the market, but also how concentrated the return profile has been in the US and also around the world, which makes managing a portfolio that's much more diversified, much more tricky. Just in terms of the labor market, we're seeing, as I mentioned, some weakness come through. But when companies are running at full capacity, unemployment levels are very low. Companies don't immediately cut staff, and you don't see that unemployment level tick up immediately. What happens first is you see a reduction in the vacancy rate, and we've seen the vacancy rate come down. In the US, you had job openings that were running at twice the number of unemployed people, and that started to come down. But also companies giving out less of an increase. And we've seen labor costs certainly start coming down. And that leads to, the point of US inflation on a downward trajectory and unemployment levels not ticking up massively. Now, do we think US inflation is going to reach the 2% Fed target anytime soon? The odds of that happening outside of a recession is very unlikely. And we think, what would most likely happen is you're going to have inflation settle at a bit higher, probably around the 3 to 4% level, rather than the 2% level that the Fed is targeting. If you do have a recession and it's a very deep recession, we will get to the 2% target. But then you have a bigger problem on your hands whereby the economy is going to be very weak and global growth is going to be weak as well on the back of the recession. The other macro theme that we're monitoring quite closely is geopolitics. We'll touch into the nuances around the geopolitical situation in the Middle East, but from a global perspective, the geopolitical tensions between the US and China continue. We've seen the latest round of the US banning the exports of high-tech chips to China, and that's impacting businesses there. Alibaba has said that their cloud computing business is going to be impacted by the ban on those high-tech chips. And you've seen China retaliate by limiting some of the commodity exports that are key in terms of electric vehicle batteries. So this geopolitical tension is something that's quite rife and something that will continue. We don't see it dissipating anytime soon. It's supported by both the Republicans and the Democrats in the US, and there's very strong support from the US public for sanctions or higher tensions between the US and China. The other geopolitical issue that's been going on for over a year is the war in Russia and Ukraine. Although that's largely been sort of ongoing, the effects of that have certainly filtered through, and we're seeing some sort of base effects and normalization from that war. So the huge spike up that we saw in the likes of fertilizer prices, where a lot of fertilizer is exported from Ukraine, that started to normalize. You saw an initial spike in the price of oil. That also has come down to less of a geopolitical premium. And then some of the commodities, such as wheat, where Ukraine is also a big exporter, has also started to normalize. It's something, whereby we're still monitoring the situation. It's not yet by any means over, the war between Russia and Ukraine. But, if it does spread to other geographical areas, that would be cause for concern. But so far, we haven't seen the second round effects post the ones that I've mentioned earlier. So those are the themes that we're monitoring from a global perspective. I'm going to go through one or two stocks that have done well in the portfolio. And the one that's up there is Microsoft. Well, you can see Microsoft has been a phenomenal performer. This is a one-year chart until the end of October. And post-October, in November, Microsoft is up another 12%. And we've had Microsoft in the fund since March 2022. And the reason why we've liked Microsoft is that, it's been a company that benefits from the AI theme, the technology theme, but it doesn't give you that cutting edge exposure that one gets from the likes of NVIDIA. And not to say that there's anything wrong with NVIDIA, but we just think from a return perspective, Microsoft is more reasonably priced, and it also has a very strong moat and diverse operating segment. So, it plays in business productivity, the cloud services, personal computing. So it has an array of different businesses, which allows them to capture the theme of artificial intelligence, but also not be too exposed, in terms of overvaluation, where some of the shares are trading at very excessive multiples. It's got a very strong competitive advantage in its core business, which is Windows and Office, which we're quite familiar with, and as well as the Xbox gaming console. And these generate very high, stable margins with recurring revenues. They've got a very strong balance sheet with lots of cash, and this allows them to make very accretive acquisitions. We've seen Microsoft bid for Activision Blizzard, which is a gaming producer company, and this allows them to strengthen their ecosystem and also get more of the share in alternative areas. They've got a very, very strong track record of delivering solid earnings, good revenue growth, and they're well positioned, to benefit from the AI theme that I've spoken about. So while, we like Microsoft, it's an anchor stock in the portfolio. It provides very good, solid, stable returns. And especially in terms of the factor styles, it's very exposed to quality and growth, which is the styles that we're targeting at this phase in the market. As I mentioned earlier, we think we passed the initial euphoria phase. We're almost in the era of a late cycle macroeconomic phase. And at this phase in the cycle, you want to favor stocks that have a very strong quality and growth element. So Microsoft has done very well for the portfolio. It's got about 10% upside from the current levels. It's trading now at $370, but it's an anchor stock in the portfolio, and we'll monitor it going forward. A stock that hasn't done well for the portfolio and features again is MTN. And the reason why we invested in MTN is because MTN has a very strong footprint across the African continent. We know it from a South African perspective, but Nigeria is bigger in terms of contribution than South Africa. And Nigeria has very favorable dynamics in terms of the population size as well as the growth dynamics. So in terms of data penetration, much lower than South Africa. In terms of mobile SIM penetration, lower than South Africa, and there's good scope for MTN to grow in Nigeria and some of the other markets that it operates in.
MT?
Yes.
Sorry to
yes, sir. I'm just good.
Just cycle the slide for us,
yes.
Please.
Sorry.
Thank you.
So, thanks, Philip. So MTN, has got favorable dynamics. We expect it to deliver double-digit revenue growth, and it has delivered double-digit revenue growth. The problem with MTN is that revenue growth doesn't translate into double-digit rand growth. And this is because of the forex devaluation that one gets from the likes of the Naira, the Nigerian currency, being quite weak and trading at levels that are very weak from a conversion perspective relative to the rand as well as the dollar. So the Nigerian Naira is trading officially at 800 Naira to the dollar, but on the black market rate, it's trading at 1,100 Naira to the dollar. So you can see, although the currency was devalued by the central bank quite massively from 400 Naira to 800, the market still thinks that that's not enough. And when you get that translation, the revenue growth into rands is low single digits and in some cases negative. So forex liquidity has been a massive negative driver for the stock. We do think that a lot of this bad news is priced in. So if you look at the chart that's above that is the sort of the enterprise value to EBITDA, the EV to EBITDA multiple of MTN. And it's trading at levels that are close to the COVID lows that we saw in 2020, as well as the lows that we saw in 2017 when MTN had tax issues in Nigeria as well. So we do think there's value in the stock. You can see our target price is 135 Rand. MTN is trading at close to 100 Rand, and we do think there's still 35% upside in MTN. Although, the timing of that value unlock is uncertain, as is in any case when making an investment. So we still do like MTN from that perspective. We think that the drivers, the fundamental drivers, are still in place, and we do find value in the stock. When would we consider divesting of MTN? And from a positioning sizing perspective, we have reduced our size somewhat, but we still have it in the portfolio. But if we do think that the fundamental case for MTN has completely changed, for example, Nigeria is no longer growing at double digits. There is a strong new competitor in Nigeria, and the investment case is completely broken for MTN. Then we would consider selling out completely. But we don't think that is the case. In the telecom space, it's very difficult for the number 2, 3, 4 player to make any money. And we've seen it in South Africa. The number 1 player is Vodacom. They make decent margins. MTN is the second biggest player. They also make decent margins. But Telkom and Cell C, which are the third and fourth operator, really struggle. And that's the dynamics in the telco sector. It's very capital intensive. You need scale, and you need a huge user base to generate decent returns because of the high capital intensity. From looking ahead, what are some of the key themes that we are going to be keeping an eye out? We've seen that the US has released their third quarter results, and from a corporate earnings perspective, companies are still meeting market expectations. So we haven't seen a collapse in terms of corporate earnings. And the reason for that is, again, as I mentioned earlier, corporates have locked in the lower interest rates, but that will come to bite at some point in time, because that debt will mature, that will need to be rolled over, and we would see higher interest costs coming through. And I think one of the reasons why you've seen, the Russell 2000, which is the smaller companies outside of the S&P 500, really become under pressure this year is for that very reason. The smaller companies didn't have the ability to lock in as much debt as the larger companies did at very low rates. And we've seen some of that pressure in terms of high interest costs come through from that perspective. Corporate earnings, companies have been able to push through quite decent price increases so far. And a large proportion of those consumer staple companies, if you take a Procter & Gamble, a J&J, a Unilever, price increases have been 9, 10, 11, 12%, and volumes have come down. But from an overall perspective, you've still seen positive revenue growth at better margins as some of those input costs have started to normalize, like oil and commodities. So you've seen, corporate earnings still quite robust, and that's sort of keeping the market, giving it some impetus in terms of growth that's coming through, and you're not seeing that collapse in earnings just yet. From China's perspective, China has been a disappointment in terms of its reopening. We've seen the reopening in the US, which was very strong. You've seen the consumer savings come through. That's buffeted a lot of the consumer spend. But in China's case, it's been different. China has two major structural problems. The one is the housing sector. There's been a lot of build in the housing sector and overcapacity. And we've seen the housing sector in particular come under pressure. And why housing is so important for China is because it makes up about 30% of its GDP. From that perspective, it has massive implications for the consumer, because 70% of household wealth is tied up in housing. So we've seen this overcapacity come through. We've seen the Chinese consumer and the psychology around the Chinese consumer being quite jaded by the COVID experience. China went through multiple rounds of hard lockdowns and quite strict lockdowns. Towns were closed. people were locked up in their housing compounds, and it was a very difficult and unsettling period. So from that perspective, the psychology on the Chinese consumer has been massive. And you haven't seen a rebound as we've seen in the Western world for that perspective. The second major structural issue that China has is that it has a declining population. So if you look at China's long-term demographic profile, China is going to lose a lot of the working age population because of an aging population, but also because of its one-child policy, which has been reversed, but we haven't seen, families having more than one child en masse. That's been very slow in terms of population growth, and China's population will decline over time. The implications for that is the cheap labor that we saw come out of China is no longer there. But also from a consumer perspective, you need consumers, you need population growth to sustain the economy, and that's not going to happen in China. US bond yields did spike up to 5% in the US. They've subsequently retreated slightly. But if bond yields stay higher for longer, which we think would be the case because the Fed is looking to bring down inflation quite aggressively. They're still targeting the 2% level, as I mentioned earlier. And bond yields are having a crowding out effect. And what do I mean by that is higher bond yields gives investors then an option to invest in lower volatility instruments with a decent return. So you're also seeing that the US bond yield is effectively the base rate for companies and for the risk-free rate around the world. If you do have a higher bond yield, it makes everything much more expensive. Companies' earnings are discounted at a higher rate. Consumers, investors have a choice to lock in rates at 5%, almost risk-free, rather than invest it in the market where you have the volatility. But also, it has quite a negative effect for emerging markets in particular, as one is able to get 5% in the US. If you add the risk premiums on top of that 5%, as well as currency premiums, when you look in South Africa's case, the 10-year bond yield is trading at 12%. So it makes things much more expensive, and the hurdle rate is much more higher. I spoke a bit about the geopolitical dynamics that we're seeing. The one that is a bit more on a micro level is the conflict in the Middle East. And we haven't seen any spillover from an oil perspective so far. Because the conflict is happening in the Middle East, it's an oil-rich region, and oil-producing countries that surround these areas. But we haven't seen a spike so far. We've actually seen oil prices on a decline. And that could be for a couple of reasons. The one could be that demand growth is quite weak. And we've seen some of the oil-producing nations outside of OPEC trying to run at full capacity, take advantage of the higher oil prices, and maximize their own their own income from a country in perspective. So we haven't seen a massive decline in oil supply just yet, but it's something that we're monitoring. If this conflict does spread to the surrounding regions, it could have massive implications for oil in particular. We've launched, I just want to touch a bit on the Shari'ah income that was launched on the 1st of October last month. Effectively, this completes all, when we do have the Shari'ah Global Equity Fund, this would complete our offering in the Shari'ah space. So this fund is just over a month old. It's a Shari'ah income fund. It's suitable for investors really looking for a yield rather than a growth element, but also looking for a low volatility, stable income Someone who's looking to save for shorter term goals and the volatility is something that they don't want to experience, this fund would suit that needs quite significantly. We could invest in local as well as offshore assets, although the offshore assets will be very limited because we don't want to bring in the currency risk that one experiences from a rand perspective, and the rand is a highly volatile currency. It would invest largely in the Sharia compliant Murabara contracts locally, as well as the Sukuks. So South Africa just issued their second Sukuk at the beginning of November. South Africa raised 20 billion rand. The Sukuk issuance was oversubscribed, and it shows that there's strong demand for these types of products. The yield on the Sukuk was very attractive, trading at a slight premium to the conventional instrument. And we did get some of that issuance for the Sharia Income Fund. We would invest a bit into high dividend Sharia compliant equity and property stocks from time to time as opportunities present. But the real focus for this fund is on yield rather than growth. We want to preserve as much capital as possible, and we wouldn't tolerate capital loss. It's all about generating income, making sure that the profile is smooth and the volatility is very low. So why this fund is different, or why we think it's different to some of the peers. We have a very integrated process from a credit and equity perspective. Our I call it credit team and equity team sits together. They liaise very closely with one another. And when we find fundamental value in an equity and the credit team finds that there are some risk from a credit scoring perspective, the interaction between those two teams is simultaneous. And that allows us to pick those instruments that we think are very robust from a credit perspective. We have the hybrid process in terms of machine learning and fundamental analysis. And really, this allows us to pick those themes and regimes that we think are going to outperform for whichever economic cycle that we're in. And then from a risk management perspective, as I mentioned, it's a very low risk fund targeting yield over capital. And it's going to be all about making sure that we get the highest yield possible with the lowest volatility. And then, if we have a strong and conservative equity process, that's going to be just about yield over growth. So that's a high level, summary of the fund. Currently, the fund on a gross basis is yielding 9.3%. The average term is just over 2 years. And you can see, Steffi, which is a cash proxy, on a gross basis is yielding 8.6%, and that's 0.2 years from a duration perspective. So we are taking a bit more duration. We think it's opportune to lock in the higher rates that we're seeing at this point in time, and we do think that rates would be lower in 2 years' time. That's it from a Sharia income perspective. The fund is not yet available on any list yet, but it's still accessible. And I'll let Verlin elaborate on the availability of the different funds on the different platforms. Thank you.
Okay, thank you very much, Imti. Much appreciated. First, let's kick off and just ask, are there any questions regarding Imti's presentation that you wanted to ask regarding Microsoft or MTN, or just some general questions around the macroeconomics that you would want to know that you have any questions about? Okay, well then, Imti, we've done a really good job by addressing all of the questions. So guys, yes, this is the platform availability of our Sharia offering. The fund is available through Sanlam, so we are just confirming the availability on the Glacier platform, but it's open for direct investment via Sanlam Unit Trust and Sanlam Tax Free. we are in the process of getting it available on as many platforms as we can. But that is a process in itself, because every platform has got its own type of requirements that you need to meet, and then they've got a due diligence and a business case process that they go through. So the rollout is ongoing, and as we go with the availability, this block will be updated to show the availability. If you've got a need for it and you don't write your business on Sanlam, but you write it on Allan Gray or Momentum, please send me an email, because that can always go along with a business case and strengthen our applications for the different platforms. Then I would just quickly like to stress that none of the slides should be accepted as advice. We do not, we're not proponents of giving advice just over the presentation, so none of it constitutes advice. It was a technical analysis in nature. So we looked at the contributor and looked at those things and detractors. So please, that's not advice to go and buy the shares. The recording will be made available on YouTube. So we did record the session, and then it's available to go and look at. If you want the recording, you're welcome to send me an email as well. We're going to take a list of the people that are in the session, and we will email the presentation to you. Then, if you have any feedback regarding improvements to the session or information that you would like to hear from our portfolio managers, kindly send me an email as well. Like I said, this session is new. This is the second session we're doing like this, and the idea is to touch base with our supporters, be they in Cape Town, Durban, in the middle of South Africa, and Teams enables us to do that. So the session will grow as we touch base with more of our supporters. And the idea is then to have an open platform where you can ask the questions that you want to ask, that you don't get the opportunity to do. And then the next session will be in February 2024. Seeing as we are winding down the year, and December is holiday season, and people tend to come back in the third week of January, start working then, if you can afford to. So the session we will pick up again in February, and then there will probably be some nice updates regarding our income fund availability. We can give some better feedback regarding the macro factors that we're looking at, and then hopefully people are refreshed and ready. This year has been quite long. So for the 5 or 6 people that logged in, thank you very much for your time. It is highly valued by myself, Imtiaz, as well. And if you have any questions, please drop me an email. And if you're going on holiday, we please ask that you do so and enjoy it and keep yourself safe. And then we will see you in the new year. So that's it from us at Sentio. If you haven't got anything else, Imti, yes, enjoy your holidays, and we hope to see you all in the new year. Thank you.
Thank you.
Thanks, guys.
Thanks, Sean.
Thank you.